Imagine if you could learn the investment principle that inspired some of the world's greatest investors and still remain relevant decades later. Welcome back to the channel. Today we are diving into one of the most influential investing books ever written, The Intelligent Investor by Benjamin Graham. This is not a book about getting rich overnight. It is not about chasing trending stocks, cryptocurrencies hype, or the latest market craze. Instead, it teaches something much more valuable: how to build lasting wealth through discipline, patience, and rational decision making. If you are a beginner, this summary will help you understand the foundations of smart investing. If you are already investing, it will remind you why emotions often become your biggest financial enemy. Stay until the end because we will cover 10 timeless lessons that can transform the way you think about money and investing. Let's begin. Lesson number one: investing is different from speculation. Benjamin starts with an important distinction. Most people believe they are investing when they are actually speculating. An investment is made after careful analysis, aims to preserve your capital, and seeks a reasonable return. Speculation, on the other hand, is driven by excitement, rumors, prediction, or hope. Buying a stock because everyone on social media is talking about it is speculation. Buying shares of a financially strong company after studying its earning, business model, competitive advantage, and valuation is investing. Before purchasing any investment, ask yourself: do I understand this business? Have I analyzed its financial health? Am I investing based on facts or emotions? This simple habit alone can save you from many costly mistakes. Lesson number two: meet Mr. Market. One of the Graham's most famous concept is Mr. Market. Imagine you own a business with a partner named Mr. Market. Every day, he offers to buy your share or sell you his share. Some days he is optimistic and offers very high price. Other day he is depressed and offers extremely low price. You are never forced to accept his offer. The stock market behaves exactly like Mr. Market. Prices fluctuate daily because of fear, greed, news, rumors, and emotions. Smart investors don't let the market dictate their decisions. Instead, they use market fluctuation as opportunities. When quality companies become temporarily cheap, intelligent investors buy. When prices become irrationally expensive, they become cautious. Remember, the market exists to serve you, not to instruct you. Lesson number three: the importance of margin of safety. This may be the single most important concept in the book. A margin of safety means buying an investment at a price significantly below its estimated intrinsic value. Imagine a company's intrinsic value is 1,000 rupees per share. Buying at 950 leaves almost no room for mistakes. Buying it is 700 gives you protection if your estimates are slightly wrong. Just an engineers build bridges stronger than necessary. Investors should buy with a safety cushion. No one can predict the future perfectly. Unexpected events happen. Economic downturns occur. Industries change. A margin of safety reduces risk and increases your chances of long-term success. Lesson number four: control your emotions. The biggest risk is not the market, it's human psychology. Investors often buy during excitement when prices are high, then panic and sell when prices fall. This creates the opposite of successful investing. The intelligent investor remains calm. Fear creates opportunities. Greed creates danger. During market crashes, experienced investor ask, has the business fundamentally changed? If the answer is no, falling price may actually represent better buying opportunities. Patience often produces greater returns than constant activity. Lesson number 5, focus on intrinsic value. The stock prices change every second. Business value changes much more slowly. Intrinsic value represent what a business is actually worth based on earnings, assets, cash flow, growth potential, competitive advantage. Market prices may temporarily differ from intrinsic value. Eventually, however, prices tend to reflect business fundamentals. That's why intelligent investors focus more on company quality than daily stock prices. They invest in businesses, not stock tickers. Lesson number 6, diversification protects wealth. No investor is right all the time. Even professionals make mistakes. That's why diversification matters. Instead of investing all your money into one company, spread investments across different businesses, industries, and asset classes. Diversification does not eliminate risk, it reduces the damage caused by unexpected failure. Think of it like planting multiple trees instead of relying on a single crop. If one struggles, the other continue growing. The goal is not to maximizing short-term profit. It's protecting long-term wealth. Lesson number 7, invest for the long term. Many people judge investments based on weekly or monthly performance. Graham believed this is a mistake. Businesses create wealth over years, not days. Successful investing requires patience. Markets will experience bull market, bear markets, corrections, recessions, recoveries. These cycles are normal. Trying to predict every moment often cause investors to buy high and sell low. Instead, focus on owning excellent businesses over long period. Time is one of the most powerful forces in investing. Lesson number 8, defensive and enterprising investors. Graham explains that investors generally fall into two categories. Defensive investors. These investors prefer simplicity. They don't want to spend hours analyzing companies. For them, diversified index funds or portfolios of financially strong companies may be appropriate. Their goal is steady wealth creation with minimal effort. Enterprising investor. These investors enjoy research. They analyze financial statements, study industries, evaluate company management, search for undervalued opportunities. This approach requires more knowledge and discipline. Neither style is superior. The best approach depends on your personality, available time, and commitment. Lesson number 9, ignore short term noise. Everyday financial news predicts market crashes, rallies, interest rates, inflation, election, and economic uncertainty. If investors reacted emotionally to every headlines, they would constantly buy or sell. Graham advises focusing on fact instead of noise. Ask questions like, is the company growing? Are profits improving? Is debt manageable? Does management allocate capital wisely? Temporary headlines fade. Strong businesses continue creating value. Avoid making investment decisions based solely on sensational news. Lesson number 10, investing is more about character than intelligence. But perhaps Graham's greatest insight is this: successful investing does not require extraordinary intelligence. It requires discipline. Average investors who control emotions often outperform highly intelligent investors who can't manage fear and greed. Great investing habits include regular investing, patience, continuous learning, rational thinking, risk management. Consistency beats brilliance. Financial success is built one disciplined decision at a time. What is the common mistake investors make? Graham warns against several common errors. First, chasing hot stock after price have already surged. Second, believing recent market performance will continue forever. Third, concentrating all investments in one company. Fourth, ignoring company fundamentals. Fifth, making emotional decisions during market volatility. Avoiding these mistakes can also alone can significantly improve long-term returns. How these lessons apply today? Although the intelligent investor was first published decades ago, its principles remain remarkably relevant. Today's investors face new challenges: social media hype, viral stock recommendation, meme stocks, cryptocurrencies speculation, AI excitement, instant trading app. Technology has changed, human psychology has not. Fear and greed still drive markets. That's why Graham's timeless principle continue helping investors navigate uncertainty. Practical action plan could be, here is a practical roadmap inspired by the book. Build an emergency fund before investing. Invest consistently every month. Diversify across quality investments. Avoid emotional buying or selling. Research before investing. Think in years, not days. Always maintain a margin of safety. Review your portfolio periodically instead of daily. Continue learning about businesses and markets. Stay disciplined regardless of market conditions. Let's quick recap the biggest lessons. Investing is not speculation. Mr. Market's emotions create opportunities. Always seek a margin of safety. Control your emotions. Focus on intrinsic value. Diversify wisely. Invest with a long term perspective. Choose an investment style that suits you. Ignore short term market noises. Discipline matters more than intelligence. The intelligent investor is not simply about buying stocks, it's about developing the mindset required for financial success. Benjamin Graham teaches that wealth is built through patience, discipline, careful analysis, and emotional control. Markets will always fluctuate. Economic condition will always change. News headlines will always create excitement and fear. But investors who remain rational and focused on long term value give themselves the best chance of building sustainable wealth. The greatest investment you can make is not just in stocks, it is in your financial education or decision making process. If you consistently apply these timeless principles, you will be better equipped to navigate uncertainty, avoid costly mistakes, and move steadily towards financial dependence. Thank you for watching. If you found this summary valuable, please like the video, subscribe to the channel, and share it with someone who wants to become a smarter investor. Let us know in the comment which lesson from the intelligent investor impacted you the most. Until next time, keep learning, keep investing wisely, and remember, successful investing is a marathon, not a sprint.